Hello and welcome to Fintech Chatter, the podcast where I connect with fintech leaders to have a chat with them about their secrets to success. Thanks for joining me on our series on housing affordability. Throughout the month of August, I've been showcasing Aussie fintech and proptech startups to talk about how we can solve housing affordability. And in today's episode, it's the turn to showcase Co-Opity and their co-founder, Lynda Coker. Lynda, welcome back. How have you been, my friend?
Good. Thank you, Dexter. Yes, we have spoken many times before on this podcast and outside, but thanks for letting myself.
I should have introduced you better. I should have been like a lady who needs no introduction.
No, that's right. I've been quite absent from the scene of late, so no, it's thank you. No, seriously, thank you for having us be a part of this series, and also thank you to you for sort of actually dedicating sort of a whole month to talking about housing affordability, which is a really big problem. And guess what? There needs to be a lot of solutions in the toolkit. So showcasing a lot of alternative solutions that are out there to the problem as well.
Well, we're going to talk about the approach that Co-Opity's taken and the problem that you've identified.
Yeah, and look, we had an election this year. How the housing crisis was definitely very topical in that debate. It is a huge problem in other parts of the world as well, but I feel in Australia it's a very concentrated problem. Property is the wealth creation vehicle of this country. So, spiraling sort of consistently high property prices has priced people out of the market. So you do have a huge disconnect and dislocation of the next generation getting in.
Yeah. So tell me a little bit about Co-Opity then and the kind of the problem that you've identified.
So myself and my co-founder, Liz Richey, when we first sort of came together to sort of start Co-Opity, we looked at a number of different angles. And as I said before, the problem's big, so there needs to be a lot of different solutions. Liz's background is she's a mortgage product builder, and Co-Opity is not a mortgage product, to be clear. And Co-Opity, co-ownership of property, is sort of, I guess, the derivation of the name. So we're very much about co-ownership on title. So we believe that co-ownership is a solution for first home buyers to get into the market, but not just first home buyers. In our research, we've sort of seen co-ownership as a very natural circumstance of many family and life scenarios. So let's do it better. But actually for first home buyers, the next generation is very open to sharing. So we are targeting related party cohorts. So to be clear, we're not matchmaking strangers, and we don't matchmake, to be clear. In terms of what we do, we don't matchmake, we don't do property search. You find each other, you find the property, you come to us, and we can do everything else. And it's about owning on title. It's not bricks or derivative or tokens or anything. You are on the title. You can live in the house should you wish. You can rent it out if you like. We don't care. We're agnostic as to what you want to do. But the point is you own it and you have full management rights to the property.
Right.
So,
this could be like friends, family. It could be a business agreement between somebody.
So our initial target markets are related party cohorts of friends, flatmates, family, but also parents who want to help their kids buy. What we are saying is what happens typically is parents gift money to their children to help with the deposit. And we're saying what you could do instead is actually use that same money to co-buy alongside, and your child borrows less, i.e. the residual. They have to come up with a deposit for the residual. They can buy sooner. The parent gets asset protection. They get a return, and there can be differing exit scenarios from that, but they get peace of mind.
So with that, you'd be able to leverage the parents' borrowing power because of their financial position and equity in the house.
They actually have to pledge less security. They pledge less security because their fraction is the security.
Right. Got you.
And this is
Cool.
estate planning too, right? So,
Yeah.
so to the extent you want to hold and you want to then bequeath in your will to the child you're helping or to the other children that you have not helped yet, there's no inheritance tax in this country and there is no CGT on that if you do it that way. But
Yeah.
obviously, if you sell, it is subject to CGT. So sort of clear it is because you're likely to not be living in the property. But we sort of
Yeah.
feel then you've made something.
Yeah.
And also there are differing sort of exit paths depending on circumstances. So we don't want to be everything to everyone. We just want to offer sort of a different pathway should it suit you. But what we are finding
Yeah.
is that this actually does appeal to a lot of parents, particularly from that asset protection angle,
Yeah.
because you gift the money. You know, your child might partner up with someone else and then they might, that relationship breaks down, there's leakage of the gift. Or if you're loaning
Yeah.
the money, because some people loan the money and that's documented. But actually the bank then views that as the debt of the child hindering their borrowing
Yeah.
capacity.
Yeah.
So this is kind of possibly a better way to do it.
Yeah. So kind of, I guess you're just putting together a more tax and capital efficient way of people being able to
Yeah,
support.
and this is sort of MVP. We sort of got a roadmap of other things we want to do, and this is like our initial target market. We've sort of come across a lot of other different scenarios that this works for. So,
Yeah. Yeah.
you know, later in life, co-buying, deceased estates, multiple children inheriting property, granny flats that's not on separate title. So you're fractionalizing ownership. So yeah, there's many scenarios that this works for. And what we're trying to do is, I guess, in this with our MVP is make it easy in terms of the transaction and putting the legals in place, because there isn't a platform that does that at the moment. In order to put the legals in place, you have to go and find a lawyer. Do you know what I mean? That can be expensive. It's all very manual. So we want to make it easy in terms of not just the legals, but actually the transactions. So we plugged in simple KYC. We've plugged in PropTrack, so we authenticate the property and the valuation, and we've plugged in Law Lab, which is a national conveyancer. Because a lot of first-time buyers go, "What's a conveyancer? What do I need to do?" So we've plugged it in, and essentially we'll execute the transaction. Albeit we do offer choice of conveyancer. We don't force people to use Law Lab, and then we can put the legals in place. So that's MVP. So that's sort of what we can do to now that's live in market. And we're partnering with brokers, lenders, and property developers in terms of distribution. But we have a roadmap of other things we want to provide to add value, not just for the cohorts that we're targeting, but also in terms of product development and what we can move on to next.
Yeah. Got you. What kind of successes have you had so far, Lynda?
Yeah, so we launched a little over a year ago, and we had lots of people come to us, like I said, with varying different use cases, which was good to see. But we very quickly realized, whilst we're solving the problem of making it easy to do the transaction and put the legals in place, we were not solving the real problem, which was improving access to finance.
Right.
So we have partnered with non-bank lenders. So we have 2 that we're working with at the moment, where they are credit assessing as a cohort and essentially enabling that parent-child, parent-off-loan construct to happen. So that has taken time because as well as I do,
have they had
Dexter,
to create like a whole...
lenders move at glacial speed.
And I was going to say,
to...
like, for them, that they wouldn't have like credit risk assessment models in place for something like this, would they?
So it's actually sort of looking at it a slightly different way. I mean, it did require changing loan docs and going through different sort of risk approvals, etc. But actually, I don't think there was too much work involved in terms of the change on their part in terms of making this happen. I would say most of the time spent to get this working has been really for them for us to prove to them. So we had to go through a lot of internal, external DD, because our legals form part of the security packet. It's enforceable by the lender. And actually that helps them because they can then go, okay, well, no one here, including the lender, wants to move to a sale of the property unnecessarily. Like if this can be worked out and if issues can be worked out, then that works for everyone. So getting to that point in terms of getting them comfortable, and then changing things on their side was really like a small percentage of time versus actually getting them to that point. So I would call that a success for us to get to this point. And
but you're still here. You're still here, right? Like that's the kind of
yes. And brokers, mortgage brokers, partnering with brokers. Brokers are key to this equation as well, right? I'm in Australia, and you and I have spent time, and presumably you've bought property in the UK before. The mortgage brokers are not so much. I mean, I certainly got my loan direct from the bank. You know.
I just walked in and went to a bank with you. Can have a bank a mortgage, right?
Whereas Australia is very different. It's very broker dominated, and I don't know the latest stats. It's kind of between 60 and 75% of flows actually go via mortgage brokers. So that's a very, very important channel for us. So I feel like there has also needed to be a curve to go up around connecting to brokers, broker education. How does this work? They have lenders that they're always kind of more comfortable working with. And I'm really sorry, but I'm going to say it, they're lazy. They don't like raising an exception to policy or, doing extra work. Often they will say to people, you know what, just go away, come back when you've saved some more money.
Yeah,
right? And I can just go tick.
It's true, yeah, it's true.
So you've got to make it easy for them. So which is what we've done, and we've gone away and made this work with the lender that will actually kind of be on their panels, and let's make this easy. But they are very, very important channel. We have some friendlies that we're working with this trial that we're in with the lenders, and also I'm sure Mandeep of Effie. So he is a partner as well. So we want to essentially, what we're working towards at this point in time is being a feature button on his platform to reach his brokers as well.
Got you. The last time you were on the show, it was almost like a reversal of that situation where you were at 1835i and you were really assessing startups and whether they were kind of, I guess, enterprise ready to integrate with a huge bank like an ANZ. Is there anything that you've kind of taken from that experience?
Yeah, it has helped to be on the other side of the fence to sort of see how we approach things. I couldn't do it without my co-founder. I mean, she is very much in this world of how to build mortgage products, and also Frank Austin, who's part of our team, he spent a lot of time in third-party distribution, so has very valuable broker networks, which, I don't have. I haven't come from that world. But also, I have to say too, despite the fact kind of, meeting you in 2016, and I was a bit new to sort of this whole startup landscape. I'd left my corporate job and was kind of exploring. I mean, this is me as first time founder too. And it's kind of very different once you get into those shoes and you're like, oh my God. So actually have to be very lean and very scrappy and just kind of getting out there and testing and making it work. And we have learned, we have certainly made mistakes. We have absolutely made mistakes. And as I said to you before, what we built as our MVP absolutely solves a problem, but it wasn't solving the real problem. So we had to then kind of go, okay, how do we make this really work? And also partnering, absolutely, I'm very much having a B2B to C and a partner leverage model. We're now also partnering with property developers. So we're about to hit live on a campaign with a national-based land and project marketer. So they sell house and land packages, and they see a lot of their inquiries come from first home buyers, because often to get the first home buyer grant, you need to be building or whatever. So they see the opportunity of working with us, particularly now that we can have financing alongside, so that you could have a co-ownership solution, an ecosystem, if you like, from property search to property settlement. And to be really clear, like, we are not the lender, we're not the property firm, but we see ourselves as the platform that can enable sort of the transaction and help it happen.
Yeah. Yeah. One of the other, I guess, reasons why I'm really excited about this space, Lynda, is that, if I look at the first decade of fintech in Australia, I think on the whole, it's been very much what I'd say kind of fee or regulatory arbitrage. There hasn't been what I would say is a great deal of product innovation or new product. Buy now, pay later was probably, the kind of best example you could give of a genuine new product to a consumer. And I think what's been really great going through this process of just chatting with, businesses like yours and startups like yours is that there's this genuine approach to building new products. Now, with that comes this whole level of complexity that we kind of saw to a degree with the kind of neo banks, is that you can't just raise a bit of capital and build a bank. It's going to take you decades to actually make that work. How are you seeing kind of this space, and do you see being able to tackle the problem without those huge amounts of capital that were absolutely required by the neobanks? I guess what I'm asking is, can 10-person, 20 people businesses with very little capital but just a lot of talent, grit, and determination make a success and be able to kind of evolve in this space?
They can, depending on what their product or service is.
Right.
So maybe it's actually useful to share here. So, I met my co-founder at Volt. We know the neobank kind of history and landscape. Frank was also at Volt, so we know how hard that is. And there were lots of sort of, reasons why that didn't work, micro and macro. When we first sort of started Co-Opity, my co-founder really wanted to lend. She wanted to build a lending product. And, I was very sort of, oh my God, no, like we do, the time to get licensed, raise lending capital, like, no, like we will not get there, we don't have, and actually, thankfully, we spoke to, and I'm sure you know them, Brian Hartzler and Jenny Fagg. Like they tried to launch To Be, which was a better reverse mortgage, and ultimately they struggled to raise equity funding to really get that going. And I sort of said to Liz, I said, if Brian Hartzler and Jenny Fagg can't raise equity capital for what is already a standard mortgage, then how are we going to do it? Right. But having said that, so very clear, we're not lending. We will partner with lenders to do this. And when I talked about before sort of our roadmap, we have a roadmap of what we envisage as a new loan. We won't be the lender, but we are very happy to work with non-bank lenders on this. And ultimately, our vision is for a fractional loan where the fraction is the security. Now, lenders aren't there yet because, they want recourse to the whole property, right? Understandably.
It's a really interesting point, actually, because if I think back to, the kind of fractional, like BrickX and, kind of some of those kind of fractional property businesses, the concept was great, but the behavioral kind of, economics behind it didn't work. And I think the reason being, right, is like, I can't give my kids the show the app and go, there's your bricks, I've got we're gonna live, right?
No, definitely. And look, that's a very different model. So with BrickX, they were buying the property. They were buying the property, putting it into a fund or unit trust structure and essentially unitizing it. So they were selling bricks where you could go, actually, I own those bricks in that house, but you didn't really own it. The people buying the bricks did not own it. And, there was, because it's very capital intensive to be the company buying the properties and doing that, and very difficult to get a secondary market happening, it's limited. So what we are doing is very predicated on tenants in common. So tenants in common is a legal framework that's been around for ages. So essentially, anyone can buy a fractional share of a property on title with tenants in common. It can be different. So, it can be there's three of you, it could be, 40, 40, 20. It could be 30, 30, 40. It can be uneven to contemplate different contributions. And whereas most people who co-buy today are joint tenants, it has to be equal, 50-50, a third, a third, a third. And also when you exit, or if something happens to one of the co-buyers, share passes to the other person or persons because you're buying it jointly. With tenants in common, there's no survivorship. So you can bequeath it in your will, or to the extent you can sell it to someone else, you are able to do that. The thing is, though, is there has never been a funding product to empower that.
Yeah.
So there is a legal framework out there that is actually, they could form the basis of a fractional on title market. There's just no lender that will ever or has essentially issued a fractional loan, because you and I know there's no liquid market out there.
Yeah.
Is there any liquid market out there where you can buy and sell, truly buy and sell on title a fractional share of a property? There isn't. But just because it's a real world asset that you can't slice into, a half or a third or whatever, doesn't mean you can't do it.
Yeah.
So
Brilliant.
ultimately, that is our kind of roadmap. But we are a long way from that. We are starting here because there is a real genuine problem with home buyers and getting them into the market. We know that co-ownership on title is a thing. We want to make it easy. So that's MVP, make it easy, transaction and legals. Let's improve access to finance for the initial target markets that we've identified. The partnership construct, the parent-child construct I talked about is sort of a quasi-fractional loan, if you like. And then we have a roadmap to try and actually build out the product to move towards that nirvana, if you like, alongside actually sort of other services that we want to provide. So, for example, at the moment, we're just doing the transaction and the legals. We want to then move to helping people, manage that arrangement for a subscription fee, So there's lots of things,
Awesome.
kind of on our tactical roadmap, but baby steps. And we really sort of want to get this working and bring it to life for that first use case.
Cool. So I guess, we're wrapping up, but before we do, if you're giving a shout out to people that are listening that could be potential, I guess, users, customers of Co-Opity, what would you say kind of would be that cohort, and where can they find out more?
Of course. So if you're wanting to get on the ladder and buy your first home, and you want to do that in a quicker, faster, cheaper, better way, definitely reach out to us. So if you're looking to buy with friends, family, flatmates, move from co-renting to co-owning. And a second ask to parents. If you're a parent and you're out there and you're thinking the only way I'm going to be able to help my child onto the ladder is gift them money, there might be a better way to do it. So
Awesome.
You can find us at Co-Opity.com and you can reach out to me, Lynda at Co-Opity.com.
Well, Lynda, it's been great to reconnect and chat. Congratulations on everything so far. And kind of great to see that you've finally taken the plunge and jumped out of the aeroplane without a parachute.
Yeah. And look, I know that you know this as much as I do. I think, it's a lot of hard work, grit, and resilience. Some people, I think, look at the startup arena as this sort of sexy, mysterious place.
Yeah.
Like, it's actually kind of a lot of blood, sweat, and tears.
Yeah.
And
I think the only mystery to it is why you started doing it in the first place. Right?
Yes. It is hard. But actually very, very worthwhile. And look, thanks for having us. It's a big problem, and there's some other amazing businesses that you've hosted on this podcast solving the same problem. It's a big problem. Let's do it.
Awesome. As always, folks, you can connect with me on LinkedIn and Twitter, or X, or whatever it's called these days. If you're new to the show, make sure you follow us if you're listening on podcast. And if you're watching on YouTube, then give us a like and a subscribe. It really helps us, one, I guess, grow the listeners and viewers of the show, but even more importantly, help great Aussie fintechs like Co-Opity and great founders like Lynda get the exposure that they deserve. Until the next episode, keep well